Okay, cheers. And it is October 21st when we're recording this, so it should be pretty timely. The government is still shut down.
21 days today, right?
21 days. The biggest factor, or the biggest market update I would say right now, is that the 10-year yield curve opened and held below 4% today, which is great news for mortgage rates because they follow that trend.
Fabulous.
But also what's released today, which is kind of why I'm saying I'm cautiously optimistic right now, is that's great news. But the MBA came out with their rate projection. Mortgage Bankers Association.
Yes, I was about to say that, and I don't want to say the wrong thing.
They came out with their rate projections, and they're now predicting that rates aren't going to change very much this year.
Okay.
I believe it's still Fannie and Freddie are still holding that they think that they'll drop a little bit more.
Okay.
So I just think that's important to address of rate drop, rate reduction isn't guaranteed.
Right.
And, we've talked so much about not trying to time the market. Do what's right. The old saying of date the rate, marry the house.
No, it's
date the rate, marry the house.
Is it? Okay.
Yeah. We've talked so much about that, and that's so true, but rate drops aren't guaranteed. So whether it's planning to purchase your next home, whether it's trying to time a refinance, when the numbers make sense, do it.
Yep.
Do it. Because yes, you could on a refinance, you could be saving $300 now. And then in 2 years, you could save another $300, which is great.
You increase your equity. If we're at a 3 to 4% appreciation year over year, 3 years from now, that's approximately a 10% boost in equity.
Yep.
So if you have private mortgage insurance on your loan, bye-bye to that, even more savings, and then your loan to value is just way.
And if you were to save the $300 now for 2 years, I'm not going to try and do mental math on that. I should have calculated that out, but I'm not
times $7,200.
Thank you.
You're welcome.
If you that's money you just kept paying.
Right.
So whether it's doing the refinance or 30-year, or I've even quoted people a 20-year, that their payment maybe goes up $50, $80. If you're comfortable with that monthly payment, you're good to go.
Exactly.
But that's not the main point of this podcast.
No, it's not.
Just a little extra.
Yeah. So relative to when we released our last episode, rates are slightly down.
Yeah. Slightly down.
Okay, great.
Great news. So
love it.
That kind of leads us into a lot of people probably prepping for spring. I know you have a ton of listings kind of lined up for the first of the year, and the process of buying and selling or buying when you're already owning, I guess that kind of leads right to me, because I think the first step is looking at the numbers.
Yep. Yeah. So today we're talking about the process of buying when you already own a house. So there's kind of 4 different routes this could go. So I'll briefly touch on those real quick. So 1 is you sell first and then you buy. 2 is you buy and then sell. 3 is contingent. So meaning you put an offer in on a home and then you say, I need to sell my house in order to buy this. And then 4 is if you're that investor type seller that wants to keep your current home, leverage the equity, rent out the home to buy your next home.
Yep.
So that's where we're going with this episode.
Yeah. And I think, I'm very passionate that the numbers should be the first one.
Yep.
In any situation, but even more so this, because most people that own right now are probably in a lower interest rate, lower monthly payment. They need to make sure they look at the numbers of what their options are and what they're comfortable with. So I think the first step is coming to talk to me, talking to a lender, that people can look at their numbers and go into detail on the options of what will work on these different scenarios and also what makes sense for them.
Yeah. I don't think it's wrong to talk to an agent first. we're still going to point you back to a lender and say, hey, talk with them, because they're going to know what you can actually qualify for. But in tandem with that talking to the lender, you do want to talk to an agent and have them run a current analysis of what your home is potentially worth, because then they're gonna take that estimated net proceeds, turn it back to Denae, and then Denae can go, okay, based on these proceeds, they can do this, this, and this.
Yeah. So the first scenario would be sell first and then buy. So that's where we really need those net proceeds, because you're more than likely going to put it back into your house. So in that scenario, it's very similar to when you purchase your first home. I think I'll let you talk afterwards, but I think on your side of it too, because you're selling, you're getting that proceeds in your bank account, and then you're going to go buy. So our calculations are, and the pre-approval process and everything is very similar to the first home purchase, like you don't own a home, because you don't by the time you're buying.
Yeah, I mean, the tricky part about that is where you live once you sell. So you need to have a really clear, solid path of like, where am I going to go? Because maybe your dream house comes up while your house is pending on the market, and that would be ideal, right? But you may still have this limbo time between your closing date and when your purchase closing date is. Like, always caution these types of sellers and buyers, like, you need to know where you're going to be. So whether it's temporary housing, there's various like residence inns in the area, expensive, a 4-person family can expect to probably pay between $5 and $6 a month to stay in one of those like one bed with a loft type condo situations. They do offer breakfast, which is nice, but so I've had a couple buyers do that after they sold. They didn't want to like rush into the next home and like feel pressured into buying something that they weren't excited about. So that's an option. Obviously, like living with friends or family, but obviously there can be like a burden type feeling there. But just like know for sure where you can temporarily be while you wait for the right home to come along.
Yep. The second option would be, I would say, offering contingent. This is very similar, but there's, on my side of it, the numbers are the same as the first scenario.
Now the only thing I will say is, what if you don't get the price that you want initially? So meaning if you're listing for, if you're listing for 1.2, you're expecting your estimated net proceeds to be 300,000, and then shoot, you're 3 weeks on market and your agent has a chat with you, hey, you need to do a price drop. I mean, how much would, like, let's say they do a 5% price drop. So what is that? 1.2. Math is really that's 60 grand. So obviously 60 grand out of their net proceeds just went away if they did a 5% drop. I mean, that, if you're contingent, I think you need to be really careful to have your lender run, okay, in scenario 1 where you sell for list price, here's what you can afford. And this house will work at those numbers. Now, worst case scenario, if we have to drop 5%, does it still work? Don't write your offer contingent until Denae or your lender gives you the go ahead.
And that's something that I always work very closely with the agents on, of like, okay, where's your ideal price? What's kind of worst case scenario? And then I ran down a little bit of like, okay, you are expecting 300,000 net proceeds. Well, let's go off of 275. And if you have 25 more, then great. That only makes things work better. But it's to kind of hedge against that. And so with the contingent offer, people will make an offer on a purchase. But there'll be a clause in there that says, we need to sell this home.
So you typically have to turn around and list your home on the MLS within 5 business days. Now, the MLS just updated it so that you can put in, whatever number you want to as far as like business days to get it on the market. Typically, you do want to get on the market in 5 business days or less, because the issue with being a contingent buyer is that if a non-contingent buyer comes along, they can bump your offer, which means the seller could accept that offer and say, hey, buyer number one, that's contingent, I need you to get your house, pending by 5 days from now. So you get notice of that. And I have had, unfortunately, a couple buyers get upped in my career. It doesn't happen often, but it does happen. So that is the one piece about being a buyer that I don't love, but it can work. And especially right now, the next 2 months, I think is the sweet spot.
Yeah.
So, come January, February, like we've always said, buyers come out of the woodwork, and it gets really crazy and frenzy in our spring market earlier.
Yeah.
In our area. So that's like my one thing that I caution.
Yeah. Yeah. I would say those two scenarios on the financial side are the most, are the safest.
Yeah.
Because you're guaranteed to not pull up 2 mortgage payments.
Right.
You get your cash, that's yours, and then you go purchase. But I feel like on the real estate side, it's a little bit more up in the air because you could lose out on your dream home purchase because you don't have the sales. So the other options would be
buying first and also having your current.
Yep. And so from the financial side, there's 2 different structures.
Yep.
You can, if you can qualify for a conventional loan or whatever loan with both payments, great. You're good to go. It's very similar. You just have to have assets to put.
Typically, what type of assets or reserves do you need to have in order to make that happen? It just depends on the loan amount.
It depends on the loan amount. It depends on the exact loan program.
Okay.
Kind of a simply put, conventional minimum down is 5%. Asterisk says sometimes you can do 3, but generally 5%. And then that's similar to just the normal process, but you need to have your own assets or other assets, and you need to be able to qualify your debt to income ratio.
Okay.
We have another.
But isn't there a program where you can kind of go like, hey, I'm going to
sell exactly.
It has to be within 6 months or whatever. Yeah.
Yep. So it's called a non-QM product, a non-qualified mortgage. And that we can exclude your departing residence,
the house you're going to sell,
but the house you're going to sell, if you write a letter of intent. And so that just means that you still have to find the assets for the down payment, and that one is 20% down. But holding 2 mortgage payments is a lot.
Yeah.
So you can come up with the assets, but you can't support 2 in the debt to income ratio. This one just removes that payment of that house you're going to sell away from your debt.
And isn't that interest rate typically higher on that?
Oh, yes. Yes, it's a non-QM product, so it's typically a little bit, but recently they haven't been that much.
Okay.
So it's been a really great product.
Investors are willing to.
Yes. Yeah.
And then how quickly do you have to sell your house?
You just have to have it listed, or you don't even listen. They don't really check. You have to write an intent, a letter of intent to list within 60 days.
So then I guess I'm trying to get at, what is the downfall of that type of loan? Like, is there a limit time-wise of, like, you said they're not checking, which is interesting.
Yeah.
Again, like, they don't get a fee slapped on you.
You just have to make sure you're making both payments.
Okay.
And that's why the rate.
One of the consequences is like you've got two more.
Yes, exactly.
Okay.
So that's a great one, and you just have to come up. Yeah.
Okay.
So a lot of the times, what I have people will come to me saying, "Hey, what about a bridge loan?" I don't like true bridge loans. They are so expensive. So if someone comes to me that had purchased a house a while ago, has a ton of equity, I would tell them to go get a HELOC on their departing residence to tap into that equity ahead of time
For your down payment on the next.
For your down payment on the next one. And that allows you to grab that and use it for your down payment. And then you can exclude both of those payments from your departing residence. You have to get that HELOC before you live. They will not lend on that on your home if you've already listed it.
Got it. Interesting.
Yeah. So that's a great option as well.
Okay.
Both of those, however, you run the risk of having
Right. I have had buyers do this, and it's not comfortable. It definitely, like, I could, as their agent, feel the stress. But they found their dream house, and I was like, okay, we can qualify for both mortgages. Is it comfortable? No, absolutely not. But for them with young kids, it was easier to transition and just go straight to that next house versus being interim housing in between time.
Yep.
The one thing that I had a conversation with them about was, hey, remember that your first mortgage payment on your new home is delayed a little bit. Yep. So that kind of helps. And so what our plan was as soon as we knew that they were pending, like those contingencies cleared, we turned around and got their house on the market within like 10 days. Put it on the market.
So you start that clock.
You get that clock going. That way that the house is ready to go. They're already planning to move anyway. And so we did a quicker close on their purchase. And then, like basically a week after we listed their house, they were already moved into the next house. And then I was able to come in and stage it. So, but obviously there's just like that stress.
I could have too. Yeah. So that's, like we kind of touched on, that's a more risky option financially, better for getting that dream home that you find when you find it. And with that, you can also, if you want to invest, if you want to build your real estate portfolio,
option number 4,
you can rent it out, right? And you can still get the HELOC if you don't have the cash. You can,
so tap into your equity from that house for your down payment on the next.
And then you just use the 75% of the lease agreement. The rental income. So we have to have a lease agreement, first month's rent and deposit, or first and last month's
paid by the renter.
Yep. And then that helps offset your mortgage payment on that.
Yeah, and I have had a couple buyers do this, and it's worked out really, really well. Typically, those types of buyers are staying in that house for usually like 3-ish years, and then they'll come to me and be like, "Hey, this isn't our dream house. We think this would be a great lease. What's the process for that?" And they're able to tap into some significant equity for the down payment on the next house, and then pretty much, I wouldn't say like nowadays could that scenario work out. I think it depends on just how much you put down initially on that house.
And when you bought it.
We can't guarantee we can get a $5,000 or a $6,000 lease payment. And, if your mortgage payment is $5,000, like that's not going to completely offset that debt.
Yeah. But for those who purchase 2022 and earlier, or 2021 and earlier,
great option.
For the overall housing market, that's part of the reason why we are a bit of a deficit still. But I think that's a great option for building the wealth.
Building a generational wealth, just, making your financial portfolio a little stronger. You've got 2 appreciating assets at that point. And obviously the con, or, maybe kind of the downfalls of doing that is like, what if your tenant trashes your home?
What if they don't pay the rent?
Yeah, correct. That's always a risk.
I think I say this a lot, with all of these options, you have to look at the financial pros and cons and the emotional pros and cons. You're purchasing your home. There's a lot of emotions within that. So I think that's what I go through with my clients, is looking, here's the financial pros and cons, and here's the emotional pros and cons. What makes the most sense for your family?
And I can tell you that not everyone is. So they're worried about getting the deal closed. And they're just not thinking about the psychology behind that, or even going like, hey, is this the right move for your family?
Yeah, exactly. So perfect. Well, we have a selling guide, don't we, for that?
do. We have a sell to buy guide that we put together that goes over all of these scenarios that we just talked about. So it goes into it a little bit more in detail. If you're a visual person like I am, I love guides and just being able to see, okay, here's the timeline, here's the process. So if you guys want a copy of that, all you gotta do is go to our show notes in the podcast, or you can go to our link in bio in our Instagram or on YouTube, grab that. It's
Or
free.
reach out.
Or reach out, DM us, we can shoot it over to you.
And we can go through, specific for you.
Yeah, absolutely. And we also have links that you can reach out and schedule a call with one of us. So that is always free, no obligation. We're just here for you guys, and we want to help you out when the time is right.
Yes. Yeah.
All right, cheers.